Right now, 92% of professional fund managers, people with Ivy League degrees, Bloomberg terminals, and million-dollar salaries, are losing to a strategy any ordinary person can set up in 15 minutes.
Not crypto.
Not real estate.
Not options trading.
An index fund.
The average American investor earns 6.3% on their money every year. The S&P 500 index has returned 10.1% over that same period.
That 3.8% gap, compounded over 30 years on a $50,000 investment, is the difference between $311,000 and $898,000.
That is not a rounding error. That is an entire retirement.
And here is what Wall Street does not say out loud.
The strategy that consistently produces those returns requires no financial advisor, no market timing, and no daily monitoring. A consistent $500 a month, starting at age 30, grows to $1.7 million by age 65, with only $210,000 ever actually invested.
In 1976, a man named Jack Bogle gave ordinary Americans access to this exact strategy. Wall Street called it Bogle's folly. They said no serious investor would settle for average returns.
50 years later, $15 trillion sits in index funds.
The people who ignored Wall Street's mockery, they are the ones retiring early.
This video breaks down the exact strategy, the mechanics, the math, and the step-by-step setup that has quietly built real wealth for ordinary Americans for 5 decades. Stay through to the end. The compounding numbers in the final section will permanently change how you see money.
To understand why this works, we must first understand the fundamental failure of active management.
For decades, the financial industry has sold the American public a very specific dream.
That if you are smart enough, or if you pay someone smart enough, you can beat the market. This is the core premise of active mutual funds. These funds employ thousands of analysts to research companies, predict economic shifts, and time their entries and exits.
However, the data tells a different, much more sobering story.
According to the SPIVA US Scorecard 2023,
92.2% of actively managed large-cap U.S. equity funds underperformed the S&P 500 over a 15-year period.
Think about that. Nearly 93 out of 100 professionals, despite all their resources, failed to do what a simple, unmanaged basket of stocks did automatically. The reason for this failure is twofold: cost and human emotion. The average expense ratio for an actively managed mutual fund is approximately 0.66%. In contrast, the average expense ratio for a broad market index fund is just 0.06%. While a difference of 0.6% may seem negligible on a one-year horizon, it is catastrophic over a lifetime of investing. This fee is charged regardless of whether the fund makes money or loses money. You are paying for the privilege of underperformance. Over 30 years, that small fee gap can cost an average investor hundreds of thousands of dollars in lost gains and compounding power. When you choose an index fund, you are not settling for average. You are choosing to capture the full return of the American economy while bypassing the toll booths set up by the financial services industry. To appreciate the scale of this opportunity, we must look at the history of the S&P 500. Since its inception in its modern form in 1957, this index has delivered an average annual return of approximately 10.7%, including dividend reinvestment. This is the heartbeat of American capitalism, representing the 500 largest and most influential companies in the United States. To put that 10.7% into perspective, if an investor had placed just $10,000 into an S&P 500 index fund 50 years ago and simply left it alone, that investment would be worth over $1 million today. Yet, for a long time, this kind of wealth creation was gated. Individual investors had to pick specific stocks or pay exorbitant fees to mutual fund managers. This changed in 1976 when John C. Bogle, the founder of Vanguard, launched the first publicly available index fund for retail investors, the Vanguard First Index Investment Trust.
At the time, the industry was horrified.
Competitors called it un-American and Bogle's folly, arguing that aiming for average market returns was a recipe for mediocrity.
They claimed that no one would ever want to own a fund that didn't even try to beat the market. What Bogle understood and what Wall Street feared was that the market as a whole is incredibly efficient over the long term. By owning the entire index, you aren't trying to find the needle in the haystack. You are simply buying the entire haystack.
This shift in philosophy has since become a tidal wave.
As of 2023, total assets in U.S. index mutual funds and index ETFs have surpassed $15 trillion.
For the first time in history, passive investing, the simple act of buying and holding the market, has become the dominant force in financial markets. But if the strategy is so simple and the returns are so consistent, why do so many people fail to achieve them? The answer lies in the Dalbar quantitative analysis of investor behavior.
Their 2023 report found a staggering reality. Over the last 30 years, while the S&P 500 returned 10.1% annually, the average equity fund investor earned only 6.3%.
This is not because the funds they owned performed poorly. It is because the investors themselves performed poorly.
This 3.8% behavior gap is caused almost entirely by emotional market timing decisions, buying when the market is booming and everyone is optimistic, and selling in a panic when the market crashes.
This brings us to one of the most critical psychological hurdles any investor will face: surviving a market crash. The financial industry thrives on volatility because it encourages activity. But for the index investor, volatility is merely a distraction. Consider the 2008 financial crisis. During that period, the S&P 500 dropped by a staggering 57%. To the average person watching the news, it felt like the end of the global financial system. Many investors panicked and sold their holdings at the very bottom, locking in their losses.
However, those who stayed fully invested in their S&P 500 index funds, those who did absolutely nothing, saw a complete recovery of their portfolio by 2013.
Even more impressive, by 2023, those same investors saw a total gain of over 400%. The lesson is clear. The market rewards those who can tolerate temporary discomfort in exchange for long-term growth. Wealth isn't built by predicting the next crash. It is built by staying in the market long enough to see the recovery. To mitigate the fear of market timing, professional investors use a mechanical strategy known as dollar-cost averaging. Research from the Vanguard Group confirms its effectiveness. By investing a fixed amount of money at regular intervals, say every month on payday, you remove the burden of trying to guess when the market is low.
When prices are high, your fixed dollar amount buys fewer shares.
When prices are low and everyone else is afraid, your fixed dollar amount automatically buys more shares.
Vanguard's research found that investors who practice this disciplined approach outperform market timing investors by an average of 1.8% annually.
It turns out that being lazy and automated is actually more profitable than being active and alert. This is why even the most successful investor in history, Warren Buffett, is a vocal advocate for this strategy.
In his 2013 letter to Berkshire Hathaway shareholders, Buffett revealed the instructions he left for his wife's inheritance.
He didn't tell the trustee to pick stocks or follow his secret formulas. Instead, he instructed them to put 90% of the cash into a very low-cost S&P 500 index fund. If the greatest stock picker of all time believes an index fund is the best vehicle for his own family's wealth, we should pay very close attention to why. Now, let us look at the sheer mathematical inevitability of this strategy when applied over time. Many people in their 20s and 30s feel they have started too late, or that they don't have enough capital to make a difference. However, the math of compounding interest suggests otherwise. If you are 30 years old today, and you commit to a consistent investment of $500 per month into an S&P 500 index fund, assuming the historical average return of 10%,
You'll be sitting on approximately $1.7 million by the time you reach age 65. What is truly remarkable about this figure is the breakdown of where that money came from.
Over those 35 years, your actual out-of-pocket contributions total only $210,000. The remaining $1.5 million is entirely the result of compound interest, your money earned while you were sleeping, working, or spending time with your family.
This is the ordinary person's path to becoming a millionaire.
It does not require a high-frequency trading desk or a stroke of luck. It only requires discipline and time.
So, how does one actually implement this strategy today? The barrier to entry has never been lower.
In the past, you needed a stockbroker and high commissions to buy into the market.
Today, major brokerage firms offer S&P 500 index funds and ETFs with virtually zero transaction costs. When selecting a fund, your primary focus should be the expense ratio.
Remember, every decimal point you pay in fees is a decimal point taken directly out of your retirement nest egg. You are looking for funds that track the S&P 500 with fees as low as 0.03% or 0.06%.
Once you have selected a low-cost fund, the most effective step you can take is to automate the process. Most modern brokerage accounts allow you to set up an automatic transfer from your checking account that buys shares of your chosen index fund the day after you get paid. By doing this, you turn wealth building into a utility bill, something that happens automatically before you have the chance to spend the money on depreciating assets.
You are essentially paying your future self first.
This automation is the ultimate defense against the behavior gap we discussed earlier. When the market becomes volatile and the headlines turn negative,
your automated system will continue to buy shares at a discount.
Building your wealth while others are distracted by the noise. The final pillar of this strategy is understanding the transition from the accumulation phase to the preservation phase. Many people worry about what happens when they actually need the money. This is where the concept of the safe withdrawal rate comes into play.
If you have built a portfolio of $1.7 million, common financial wisdom, often referred to as the 4% rule, suggests you could withdraw roughly $68,000 in your first year of retirement,
adjusting for inflation thereafter, with a very high probability that your portfolio will last at least 30 years. Because the underlying assets are the 500 largest companies in America, your wealth is anchored to the actual productivity and innovation of the global economy. It is important to address the critics who say that index investing is too crowded, or that the future won't look like the past. While it is true that past performance is never a guarantee of future results,
betting against the S&P 500 is, in essence, betting against American ingenuity.
For the index to fail permanently, the 500 largest companies in the country, Apple, Microsoft, Amazon, and hundreds of others, would have to collectively stop producing value.
History has shown that while individual companies rise and fall, the index itself is self-cleansing.
It automatically removes the losers and replaces them with the new titans of industry. As we look at the landscape of 2026 and beyond, the noise in the financial world has only grown louder. You will be constantly bombarded with the next big thing. Whether it is a new AI-driven coin, a specific tech stock, or a complex hedge fund strategy. But remember the data. 92% of the world's most sophisticated investors cannot beat the simple path you have learned today. They are working harder to earn less, while you can work less to earn more. The path to wealth is not a secret, and it is no longer reserved for the elite. It is a mathematical certainty for those with the patience to wait and the discipline to remain boring.
Start today. Open that account, select a low-cost S&P 500 index fund, and set up your automatic contribution.
Your 65-year-old self will not remember the market volatility of this year or the next, but they will certainly feel the difference of that $1.5 million in compounded growth.
The folly isn't in buying the index. The real folly is waiting another day to start.